While most people were staring at price charts and daily candles, the real decision was happening far from the screens. Behind closed doors in Basel, Switzerland, regulators made a move that quietly reshaped the entire financial system. The Bank for International Settlements, often called the central bank of central banks, officially pushed through the final stage of the Basel III Endgame rules. This was not a leak or a rumor. It was a signed mandate, scheduled to take effect as markets open on Monday morning. They kept it quiet because they understood how disruptive it would be. At the heart of this change is how banks are allowed to hold gold and silver on their balance sheets. For decades, paper promises were treated almost the same as physical metal. Banks could hold unallocated gold and silver, nothing more than accounting entries, and still call them safe assets. Starting Monday, that illusion breaks. The new rules changed the net stable funding ratio, making paper metal expensive and risky for banks to maintain. Holding unbacked positions now comes with real penalties. This forces banks into a corner. They have only two realistic options left. Either they acquire physical gold and silver to properly back their exposure, or they exit the paper market entirely. There is no comfortable middle ground anymore. These rules were designed to prevent another crisis like the one in 2008, but in doing so, they lit a fuse under the precious metals market. A system built on leverage suddenly has to respect reality. For decades, massive short positions kept silver prices artificially low. That strategy is no longer viable. Large institutions can no longer carry enormous short exposure without tying up huge amounts of capital. The cost of holding those positions has exploded. Manipulation becomes unprofitable when compliance itself is expensive. That is why we are already seeing short positions being unwound in overnight markets. This is not speculation. This is forced behavior driven by regulation. The most important shift is the reclassification of gold, and by extension, silver as Tier 1 assets. Previously, gold was treated more like a risky investment, similar to equities. Now it is considered risk-free capital on the same level as cash or government bonds. This single change flips incentives completely. Banks move from suppressing prices to strengthening their balance sheets with physical metal. When sellers become buyers, the entire price structure resets from the ground up. This shift also explains the strange liquidity vacuum we saw unfolding last week. Sell orders suddenly disappeared, spreads widened, and parts of the market seemed to freeze. That was not a glitch. It was anticipation. Banks knew these rules were coming and pulled back deliberately. They did not want to be caught short when the new framework officially went live. Market makers stepped aside to recalibrate their risk models for a world where paper leverage no longer dominates. The game quietly changed from suppressing price to securing supply. Once you understand that, the recent behavior starts to make sense. When banks stop flooding the market with synthetic supply, prices do not need hype to rise. They move higher simply because real metal becomes scarce. True price discovery cannot exist when unlimited paper dilution is allowed. With that mechanism restricted, the market has to adjust to physical reality. Industrial players are fully aware of this shift. Companies like Tesla and Samsung depend on silver as an essential input, not a financial asset. They understand that if banks stop providing paper silver, prices will rise until physical demand is rationed. That is why industrial buyers have started locking in supply aggressively. They are not speculating. They are trying to secure production lines before banks absorb available inventory to meet regulatory requirements. This has created a silent race. On one side, factories need silver to keep manufacturing running. On the other side, banks need silver to satisfy capital rules. The uncomfortable truth is that there is not enough metal to satisfy both simultaneously at current prices. Something has to give. Either demand gets destroyed or prices rise until supply rebalances. History tells us how that story usually ends. China saw this coming long before the West did. The Shanghai Gold Exchange already operates on a fully allocated physical model. Paper claims, without metal backing, do not qualify. While Western markets relied on leverage and trust, the Chinese system demanded delivery. This regulatory shift is an admission that the physical model won. The West is not leading this change. It is catching up. By aligning with these rules, Western regulators are quietly admitting something important. Paper derivatives are dangerous, and physical metal is the only true form of safety in times of systemic stress. This is not an ideological shift. It is a survival decision. When leverage grows too large, reality eventually asserts itself. These regulations are that moment of confrontation. So, why should you care about any of this? Because while the banking system becomes safer over the long term, the currency used to buy gold and silver becomes weaker in the process. Banks will need to raise cash to acquire physical metal. That means selling dollars and government bonds. This creates downward pressure on the currency and upward pressure on hard assets. When gold and silver are revalued higher to meet Tier 1 standards, fiat purchasing power has to fall. In simple terms, the revaluation of gold is the devaluation of the dollar. They cannot both rise together. One must absorb the shock. And history shows that currencies always take the hit. If you hold an unallocated silver account at a bank, this rule is not neutral for you. It is a direct risk. Holding that liability now costs the bank money. The incentive is no longer to protect your exposure, but to eliminate it. That is why we expect banks to begin closing unallocated precious metals programs. Clients will receive letters saying the service is being discontinued and their balance will be converted to cash. On the surface, it sounds harmless. In reality, it forces people out of metal at precisely the wrong moment. If you do not hold physical silver, you are exposed to being cashed out before prices adjust upward. You will not hear about the net stable funding ratio or Basel III on the nightly news. It is too technical and too dull for mainstream coverage. Instead, the media will talk about volatility and uncertainty. They will never explain the plumbing behind the system. But this is where real change happens. The era of unlimited leverage quietly ended while most people were distracted. This moment is far more significant than most people realize. What just happened carries the same weight as Nixon closing the gold window in 1971. Back then, the world moved away from metal and into pure fiat. Today, under the cover of regulation, we are moving slowly back toward metal again. It is not announced as a return to a gold standard, but functionally, that is exactly what is happening. Central bankers understand the debt trajectory is unsustainable. The numbers no longer work. They cannot raise rates high enough to control inflation without collapsing the system. So instead, they are changing the definition of what counts as safety. Gold and silver are being quietly repositioned as anchors of trust. When institutions prepare lifeboats, they do not build them out of promises. They build them out of metal. With banks stepping away from price suppression due to rising costs, true price discovery finally has room to emerge. In the short term, this can look chaotic. Volatility will spike as paper shorts are forced to cover, but beneath that noise, the long-term trend is already set. Prices must rise until physical supply can meet physical demand without the distortion of synthetic leverage. That equilibrium price is far above current levels. It is not a guess or a prediction. It is a mathematical consequence of reduced paper supply and rising physical demand. At the same time, because banks must hold more capital, lending will tighten. Credit becomes harder to obtain. Mortgages and business loans become more restrictive. This creates deflationary pressure in the real economy. To counter that slowdown, central banks will respond the only way they know how, by printing. The result is stagflation. Growth slows while prices rise. In that environment, silver has historically outperformed nearly every asset class. It thrives when confidence in currency erodes and tangible value matters again. The most rational move in times like this is alignment. If the banks are being forced to hold physical metal, that signal matters. If they are exiting paper contracts because those structures are no longer viable, that signal matters even more. Betting against regulation is rarely a winning strategy. Capital always flows toward the path of least resistance, and right now that path leads directly to tangible assets. Monday morning marks the beginning of a new chapter. The Basel III era officially starts, and banks across the system are scrambling to adjust. Short positions are being reduced, physical inventories are being prioritized, and paper exposure is being reevaluated line by line. This is not panic, it is compliance. And compliance creates powerful and sustained demand. This is not a conspiracy or theory. It is a regulatory reset written in black and white. The rules changed, and the incentives changed with them. For decades, the paper market dominated because it was cheap to maintain. That advantage is gone. The physical market is now the foundation, not the afterthought. Once that shift is complete, prices do not return to old ranges. For years, the London Bullion Market Association operated with a loophole that allowed unallocated gold to be counted as a high-quality asset. The same bar could be leased multiple times, creating layers of claims on the same metal. Basel III closes that loophole. Tier 1 assets must be allocated and physically present. This forces clearing banks to locate real inventory, not accounting entries. Fractional reserve bullion banking is coming to an end. When London is required to meet these new ratios, the drain on global vaults will accelerate rapidly. Physical metal will leave the system at a pace the market has never experienced, and once it is gone, no amount of paper can replace it. The impact of these rules goes far beyond precious metals alone. The entire derivatives market rests on the quality of banking collateral. When banks are forced to hold better collateral, trading leverage becomes more expensive across the board. Gold and silver raise the cost of risk. As a result, we should expect a broad deleveraging event as positions that relied on cheap funding become unviable. Hedge funds that built strategies around shorting silver with borrowed capital will feel this pressure first. Banks will no longer lend at favorable rates for trades that consume excessive balance sheet space. Positions that once looked safe suddenly become liabilities. This will force funds to close shorts, not because they changed their view, but because the structure no longer works. This short covering will not be driven by optimism or fear. It will be driven by mechanics. When funding disappears, exits are mandatory. That kind of buying pressure is powerful because it is not discretionary. It happens regardless of price. And when multiple players are forced to exit at the same time, the move accelerates quickly. Large sovereign wealth funds understood this shift well in advance. Funds in the Middle East and Asia began positioning years ago, anticipating that gold would eventually reclaim its role as a core balance sheet asset. Once the rule became official, their preparation turned into validation. We should expect public announcements of increased precious metals allocations as confidence builds. When an institution managing $1 trillion allocates even 1% to silver, the effect is dramatic. That amount of demand cannot be absorbed quietly. While Basel III focuses directly on gold, silver benefits by proximity. Historically, when gold reasserts itself as monetary metal, silver follows as its more accessible counterpart. As gold regains its status as central bank money, silver quietly reclaims its role as money for the people. The relationship between the two has always been cyclical. When gold is officially elevated, silver is usually the asset that lags first and then accelerates harder. This is why the gold to silver ratio becomes so important in moments like this. That ratio is not stable when monetary rules change. It contracts as silver catches up to its historical role. What we are witnessing is a stealth remonetization of the entire precious metals complex. It is happening without headlines or ceremonies. It is happening through balance sheets, audits, and regulatory language. But the effect is the same. Metal is being pulled back into the center of the financial system after decades on the sidelines. Ironically, these rules were designed to make banks safer, yet in the short term, they expose just how fragile many institutions really are. A large number of banks do not have enough physical metal to meet the new standards. To comply, they must buy metal in open markets while still carrying legacy short positions. That creates a dangerous feedback loop where following the law pushes prices higher against their own exposure. In extreme cases, compliance itself can become fatal. Buying physical metal drives prices up, which increases losses on remaining short positions. Losses force more buying, and the cycle feeds on itself. In that scenario, central banks may be forced to step in and print currency to stabilize the system. That intervention would be inflationary by design. This is where the conflict becomes visible. On one side, regulators are demanding hard collateral. On the other, central planners are pushing for digital control through central bank digital currencies. One faction needs gold to survive. The other wants programmable money to dominate. In that struggle, the individual investor has a rare advantage by holding the asset both sides ultimately depend on physical metal. With these new rules come new audits, and this is where things get uncomfortable. Regulators will not rely on trust anymore. They will verify. Vaults will be inspected, documentation will be challenged, and metal will need to be physically present. Paper claims will not be enough. We strongly suspect that many institutions have been counting leased metal as if it were fully owned. That illusion cannot survive an audit. When auditors arrive this quarter, any bank that cannot prove it has the metal it claims will face serious consequences. At best, it will be forced into an emergency recapitalization. At worst, it will be shut down or absorbed. This is why demand for fully audited, serial-numbered physical bars is rising sharply. Proof of ownership is becoming as important as the metal itself. There's another layer to this shift that most people are not considering: miners. These rules change incentives for them as well. When banks suddenly need massive amounts of physical metal to meet regulatory ratios, miners become direct suppliers to the financial system. Instead of selling into the retail market, they can sell directly to banks at scale. If a major institution needs tens of millions of ounces to comply, it will not source that metal from coin shops. It will go straight to the mine. That bypasses the retail market entirely. Industrial users and retail investors are left competing over a shrinking pool of remaining supply. This is how squeezes form quietly, without headlines. As banks and institutions hoard metal for compliance, availability tightens everywhere else. Premiums rise, delivery times extend, and the retail investor feels the pressure first. The market does not break all at once. It constricts slowly, then suddenly. Although the rule officially begins on Monday, the implementation is not a single moment. It is a process. Banks have been given a transition window, but markets do not wait for paperwork to finish. Markets move in anticipation. They price the future before it arrives. That is why the smart money is already positioning. They are not waiting for the final deadline to react. By the time the full effect is visible to the public in 2026, prices will have already adjusted. That is how these cycles always work. When clarity finally reaches the mainstream, the opportunity is gone. The price of silver will not wait for confirmation. It will move as capital reallocates quietly in the background. This is why Basel III is not just another regulatory update. It is the catalyst that forces honesty into a system built on abstraction. Paper manipulation ends not because institutions chose integrity, but because regulation removed the incentive to lie. Honest money always demands a higher price. That price reflects scarcity, effort, and trust. Banks are buying. Nations are buying. Large funds are buying. They are not doing this out of belief or ideology. They are doing it because the rules force their hand. When the largest players in the system are moving in one direction, fighting that flow becomes increasingly dangerous. The real question is no longer what the price should be. The question is positioning. History shows that when financial rules change, wealth moves quickly. Those holding paper promises are diluted. Those holding tangible assets preserve purchasing power. The cycle is turning again, and the signal is written directly into the rulebook. History never repeats exactly, but it often rhymes. In 1933, gold was confiscated so it could be revalued. In 1971, gold was abandoned so money could be printed without restraint. Now, in 2026, under the framework of Basel III, gold is being quietly remonetized to stabilize a system under strain. Each shift marked a massive transfer of wealth. The pattern is familiar to anyone paying attention. Every time the rules changed, paper holders paid the price. Those who trusted promises watched their purchasing power erode. Those who held physical assets endured. This transition signals that the cycle is turning once again. The system is acknowledging that fiat currency has reached its limits and is retreating toward something more solid. Why now? Because inflation has proven stubborn. Central banks know they cannot push it back down to 2% without triggering a deep economic collapse. So instead of fighting inflation directly, they are redefining what qualifies as safety. By elevating gold and silver to Tier 1 assets, they are creating a new anchor capable of surviving prolonged periods of high prices. This prepares the system for a decade where inflation is not an exception, but a feature. If banks are hedging against that reality with metal, ignoring that signal would be a mistake. Institutions do not hedge casually. They hedge when they see risk that cannot be managed any other way. For 40 years, government bonds were treated as the ultimate safe haven. Basel III quietly challenges that assumption. By placing gold on the same level as sovereign debt, regulators are admitting that bonds, which lose value when rates rise, are no longer sufficient on their own. This sets the stage for a long-term shift of capital away from bonds and toward precious metals. Even a small reallocation from the bond market has enormous consequences. Trillions of dollars are parked in government debt, not because it is attractive, but because it was considered safe. If even 1% of that capital begins to rotate into silver, the impact is explosive. The silver market is simply too small to absorb that flow without repricing sharply and quickly. You have probably heard the phrase global reset thrown around loosely. This is what it actually looks like. Not a single dramatic event, but a series of structural rule changes. Basel III is one of the key pillars of that process. It quietly places gold back at the center of the financial solar system, where everything else orbits around it. This also marks a subtle shift away from a United States-centric dollar system towards something more neutral. An asset-backed framework reduces the advantage of countries that rely purely on financial leverage. It levels the field for nations that spent decades accumulating physical reserves. China and Russia benefit from this alignment because metal does not recognize borders or political narratives. Through regulation, the West is conceding economic ground to the East, not through weakness, but through necessity. When leverage becomes dangerous, collateral becomes king. And gold is the only collateral that every system recognizes without debate. This transition is not ideological, it is mathematical. The document is signed, the rule is active, banks are already moving. The window to position ahead of this shift is closing faster than most people realize. Once the full weight of institutional demand enters the physical market, access will narrow and prices will no longer wait for hesitation. Do not wait for the news to explain what is happening. By the time headlines catch up, the positioning phase is already over. The media speaks in narratives. The system moves through rules. If you want to understand where capital is going, look at what regulators are forcing institutions to do, not what commentators are debating on television. This shift is not emotional. It is not ideological. It is mechanical. Banks respond to incentives, and those incentives have changed. They are buying what strengthens their balance sheets and abandoning what creates risk. Following that behavior is not speculation. It is alignment with power. The paper game relied on trust, leverage, and complexity. That era is fading. What replaces it is simpler and harsher. Physical assets, verifiable ownership, limited supply. When the system is forced to be honest, prices rise to reflect reality. Gold and silver are not becoming valuable because of hype. They are becoming necessary. Every major transition in monetary history created winners and losers. The losers were always the ones holding abstractions when the rules changed. The winners were the ones holding what the system eventually needed. That pattern has never failed. It is unfolding again, quietly through regulation. They passed the rules for a reason. Follow the incentives, not the rhetoric. Buy what the banks are being forced to buy, not what they are trying to sell. The reset is not coming. It is already in motion.